morning, everyone. This is Mortgage Pros 411. I'm Audrey Boyce-Snow with my co-host Kevin Casey, and today we are joined by Tricia James. If you're wondering why she's slouching, her back is killing her. She was almost run over by a truck the other day in a parking lot, so she's got that going for her.
I bet the truck took the worst of that.
No, it took out her shopping cart,
Yes,
everything, broke the woman in
yeah.
her leg. Yeah, it was a thing. A big thing. All right, kids. So it's September. Hallelujah. I don't know why, but August seemed like it was really long and really not easy. So I hope that September is better, for God's sake. It is almost the end of what? Q3. And what should we be doing? Thinking about how we are going to burn it up the last part of this year. And so we're going to talk about that today. But first, I just want to say that we have some NMLS classes set. So we will be in Sausalito on the 23rd. That will be live at the Yacht Club. It's the most beautiful setting on earth, for God's sake. If you are in the North Bay or San Francisco or anywhere close by, join us. It's fan-freaking-tastic. Then in October, on the 10th, for the Greater Ventura Camp, we're going to be doing a live NMLS class, and it's in Westlake Village. And we have some sponsors. Tricia is going to be one of them, believe it or not. She is going to get in her car and go somewhere and be amongst people. It'll be great, right, Tricia?
Yes, I'm excited.
Yeah, so excited. There, just so you know why I think that's funny is there was a time where Tricia had a little, what do they call it, agoraphobia? She wouldn't leave her house. I mean, she'd say she was going to be somewhere,
No.
big lie, and here we are. So, there you go. So October 10th, we'll see you. Good God, woman, I'm going to need a Benadryl. It's so blurry, and there you go. That's better. Okay. So anyway, all right. With that being said, guess what else it is this week? Jobs week.
Jobs week.
Jobs week. Because why not put that in the middle of a short week so we can have as much volatility as possible?
Why not?
We're doing all right. Mortgage-backed securities are happy. We are at 3.85 on the 10-year treasury. But just so you know what's coming up, tomorrow, we have the JOLTS report, the job opening and labor turnover. They're expecting it to be a little lower. We're going to have mortgage applications in the Fed beige book. And on Thursday, we have ADP coming in, and they are expecting 145,000 job creations. We'll see. We'll see. And then we'll also have initial jobless claims. And then last, but certainly not least, on Friday, we're going to have BLS. What is that? The Bureau of Labor Statistics, my favorite report of the month, because they're so accurate. Oh, wait, no, that's not them. So
no, wait, they adjust that accuracy. And then after they've adjusted,
They reinstate,
don't even. I have not taken any sort of sedative tranquilizers this morning, so don't even get me started. They're expecting 165,000 jobs created. We'll see how that goes. There's also an expectation that the unemployment rate will go from 4.3% to 4.2%. So that should be interesting. But I will say, whatever happens, whatever monstrous BS they decide that they're going to share with us on Friday, we can expect for it to be revised later. But we also know that the Fed is really going to look at this number. So they're going to look at this. So September 18th, we're expecting 25 basis points cut. We'll see whether they go 50 or, as one of our senators is demanding, 75 basis points.
Well, the senators, they know everything about the economy.
Right. Just like the presidents who think that they should run the Fed and monetary policy. Okay. I'm going to keep breathing. So all that, we got PCE last week, and what happened? Came in very good, thank God. Headline was at 0.155 month over month. Core was at 0.161 month over month. You take the last 3 months, the run rate is 1.704%, which is below Fed's expectation and desire for a 2% core, but they really prefer to look at 6 months. They do look back, though, at the last few months, so that will count. But it's not going to be the end all. But the point is that the core PCE is coming down. That is what the Fed is looking at. So between that and then this week's jobs report, that will give us a very good idea of what is going to be happening on September 18th with the Fed cut. So And just for the record, we have core PCE right now is at 2.62%. If we had shelter where reporting what is actually real-time shelter versus the lag that we get in these inflation reports, we would be at 2.22% core instead of 2.5 or 5. Good Lord, I've lost my damn mind. We'd be instead of being at 2.62%. So with all that, that's a lot. Bottom line is inflation's coming down. Hallelujah. Thank God. Right.
The bottom line is gonna be a very busy week on rates. So
yes,
probably lock in earlier than later.
Pay attention and do not
ready to hit that lock button.
Just pay attention. Just be on top of it and don't just, don't expect that everything is going to go in a straight trajectory because
expect volatility this week.
Oh, and by the way, who else? Every other question I hear from anyone is, or not, it's not even a question. It's a comment. The average person on the street is like, so I hear the Fed is going to lower the rates in September. Everybody has caught that headline. Everyone. So what is it they don't know about that headline?
The rates have already come down.
Well, yeah, that the decrease in the Fed funds rate is baked into the market, right? So anyway, it's interesting out there. Tricia, you're dying to say something. Please do share with the group.
No, I mean, here's the thing. As a lender, you have a lot of people sitting on the sideline waiting to lock because the borrower's waiting for a certain amount of data. There is a certain point priced in, but there's also things that lenders do to maybe slow the pipeline or mid-month things. So when Kevin said lock, I know people with $1 million, few $1 million loans this morning that today they would have lost a quarter because we revised pricing very shortly after it came out. What I'm saying is whenever you're getting into the beginning of the month, it's really important to lenders put out their price, then they kind of look at their pipeline, they might have meetings and stuff like that, and you'll see a reprice usually the first 3 days of the month that makes corrections to adjust to market conditions. So it's not just the Fed's data. It's not just economic data. It's also your lending partner. Make sure, how do they normally price? We have some lenders that when the market's crazy, they don't have control of the situation. They do 5 reprices in a day. We've seen that. I mean, I've seen 8 prime lenders.
Prime, yeah.
What?
Yeah. I thought you were saying non-QM. I'm like, holy guacamole, that's crazy.
No, non-QM lenders, you really shouldn't see that.
Yeah, exactly. And just to defend Kevin, he didn't say lock. He was saying watch. Like really, like you just want to make sure that you're paying attention, that you're ready, that you're really educating your borrowers. So that kind of information, Tricia, is a great reminder because
we talked about that a little bit last week, where lenders, if their pipeline starts to fill up, they'll raise their rate. Not because the market says the rate should be higher, it's because their pipeline is filling up and they don't have the capacity for more loans. So that's how they stem the tide. Correct?
Well, correct. But the conversation that needs to be had between the borrower and the loan officer is, what rate do you feel comfortable with?
Yes.
And that's the rate you need to target locking. So when you take that application and a borrower's waiting for a certain rate, I have a perfect example. I have a guy today that has $127 million. He wants to refinance it at 5.99. We're at 6.25 this morning. I said, start getting those loans in, because when we hit 5.99, we're not going to be ready for your 600 and some thousand or your loans. And he's like, really? And I said, yeah, because the lender, when the floodgates open, they're not going to go to the rock bottom price because they have enough loans coming in.
Right. Well, I had the same conversation with a borrower this weekend who texted me and she's like, hey, I want to refinance my rental property. And so I had a conversation with her yesterday and we talked through it. And I said, let's get it all ready to go because, and I'm sure you've heard that the Fed is going to lower the rates, but that's the Fed funds rate. And that doesn't necessarily mean mortgage rates are going up or down. And so what I would like to have is for us to be ready when that all goes down. And then we can make a decision about what our next action is going to be. So it's going to be really important to make sure that you're proactive, you're thinking ahead, and that you're having really good conversations and agreements with your borrowers.
I think we're all in agreement on that one. There's nothing to debate. What, give me something to challenge you on that one.
Okay. All right. So Tricia, I have a few things that I'm curious. And just to be clear, Tricia has a business that spans the country. So she's working with LOs and loans in most states, right? Or many states. We'll just go with many states. Which ones is unimportant. But why don't you tell us a little bit about what you do so that we have some idea of the breadth of your coverage and what you see?
I do non-QM, and I've done it successfully probably for 34 years, and it had another name prior to non-QM. We won't go there, but
Sure.
what I like to say is I do loans that are non-prime. So I have a 34-year relationship of non-prime loans. Do I do difficult loans? Yes. Do I do ITIN, DSCR, recently newly self-employed? The challenges. Also, part of the reason of being national rep is I need to know situations that are going on. Like, for example, the condo situation across the country is real. The amount of insurance or lack of coverage people can get is real. So a lot of loans that wouldn't go into a non-QM portfolio are in a non-QM portfolio because of recent changes in the way condos are insured, the amount of money that they have and stuff like that. The other thing, as far as doing non-QM, I try to explain to people, it doesn't mean that the borrower has bad credit. It means the situation does not fit a prime situation. It could be income, it could be credit, it can be property. Also, I now in my career have partnered with a CDFI lender. What that does is a CDFI lender is we do loans that banks don't do. So they're identified as products that banks no longer offer, like log homes, for example, or property or what?
Dome buildings, roundhouses, anything like that.
I'm not doing a geodesic dome.
What?
No. But no, I'm not doing a geodesic dome. You can do an owner occupied loan, no income, no asset, no ratio. I'm no income, no employment, no ratio. You still need assets. So it's going to be based on the assets. Again, you want to, and that's part of the reason I'm doing this show, is you want to make sure you partner with different lenders, because not every borrower you have fits the credit criteria, the income criteria. Things change, life changes. You want to make sure you have relationships with other lenders too, to get you out of the situations or get the borrower out of situations, so you don't lose your clients that may go through a different or challenging time in their life.
Exactly. I think that is so important to remember, as a lot of people, whether you work for an independent mortgage bank or a retail bank or a broker, it doesn't matter. I know brokers who send all their loans to one lender. That is not the way forward, kids. I mean, so I work for an independent mortgage bank, but I have been brokering 99% of my business in the last year. 99. Yeah. Yeah. So it is figuring out, where does your client fit? What best serves them? What do you need to do for them? It should be all about the client, not about us. It's not about us. It's about, what does the borrower need? So knowing that you have all these outlets, so I get these funky situations, and let me tell you something, I know what to do with them, or I know to look. Maybe I don't know what to do with it, but I know there might be something out there. So I start poking around. Remember in the old days, Tricia, Kevin, you both remember this, dialing for dollars. That's what we called it. We get on the phone and we start calling our reps, and we would find what we needed. We talk through scenarios. I mean, that old school approach is still the best way for me to find an outlet for my loan. As much as there are places that want to just, look at our website or read my email or whatever, forget about it. Like, I know of a lender where if you have a non-QM loan, they send you a job aid And I'm like, I don't work with them because I need to have a conversation with a rep who knows what the heck they're doing, understands the guidelines, and might be thinking of something I'm not thinking about in that context. So
Absolutely. No, I'm dealing with right now with
critically important.
a couple commercial deals I'm dealing with, and it's not just the rate, it's what's the prepayment penalty? What's the terms? What's, what is the renewal like? What's the, give me all the details on this loan. It's not just rate, although the client's like, well, I want the best rate. I'm like, okay, I'm not just shopping for rate. I'm shopping for the prepay. I need to figure out what works best in this client's interest. Hey, what is your plan to pay down this loan? And this one particular guy, he's planning on accelerating the payments. Like, okay, well, you need to keep those prepay payments down to 20% per year, or you're going to have a prepay penalty if you overpaid. And watch the fact that yes, you can pay down 20%, but you're also, with your mortgage payments, you're paying down your payments. So don't just go, okay, I borrowed $500,000. I want to pay down $100,000 each year. Include what's going to be paying down with your payments in there, or you're going to get a penalty on the amount that's over it.
Or your ratios are tight. And in the conversation with your rep, they might say, hey, you could add in this kind of, do you have assets? You could do asset depletion, or have you thought of this or whatever, right, Tricia?
Yep.
Or you can go interest only. Like I tell people, especially if you have rental property, throw interest only in there, because then the might have trouble making the payment. You have that lower obligation, technically on the property. Kevin, on the commercial space, we have seen a huge tighteners on the commercial market.
Crazy. Yeah, it's very tight. And I was talking to a commercial guy. He's saying that 7 of 7 applications he gets that are solid leads, only 1 is getting approved right now.
Correct. And that's what I try to tell people. I'm like, there's a flight to quality on the credit side of commercial. Yeah. And so when you're having these conversations with clients and partnering with lenders, make sure you have 1 or 2 or 3 in that space, because the amount of business that's out there, commercial loans usually 5, 7, 10 years, and a lot of them are mature. I don't remember what the exact number is, maturing 2025, 2026, an ungodly amount, and those loans need to be refinanced. Lenders, knowing that, I think, are picking and choosing the buildings and the areas they want to be in, not redlining, but setting credit requirements up and income requirements up on those areas to make sure that these people, they get the loans that they want.
There's redlining going on too. I'm telling you for a fact, but I've seen it. You can't call them on it, but it's like, no, oh, it's over there.
But I think it's not always, I don't like that area. It's how much risk do I have in that area, So, because we're seeing that with insurance where you've got
saturation of risk.
Exactly. Yep. So you've got a bunch of people in this area. They don't want to own all of it. So if that neighborhood goes down, again, this is insurance, but again, you want to make sure you're diversified and you've spread out your risk, is what I'm seeing.
But back to that condo. Okay, so in our condo situation where we're getting condos through that no one can, then the loan agent's approaching the rest of them and trying to get the rest of the building. As a lender, we don't care about the saturation in that case. So when you have condos that only have 80% insurance coverage and you have to go to a non-QM lender and that lender is able to get that deal, you're better off sticking with that lender than shopping around, because in the condo realm right now, it is hard to get loans through with insurance and HOA dues and reserves and everything else that's going on. The Fannie Mae requirement on wind insurance for Hawaii, Texas, what's it called? The Carolinas and Florida. That has taken so many projects out of the availability of doing loans. I have a loan officer right now in Florida. He was the first one to close a loan this year. Mind you, we were in August in a project. And the association, when we closed it last Wednesday, reached out to him and said, could you please reach out? We're going to have a meeting with our board. Can you please come to the meeting, because we have people alleging that they cannot get loans, and we're going to use this loan that we were able to secure with you.
The other thing too I'm seeing or hearing with condos is people are like, oh, well, we were FHA approved or this approved or that. And the idea, they don't understand the concept of that can be there one day and gone the next, literally. When was the last time your insurance renewed? What is your new deductible? Does it meet the guidelines? I mean, how are your reserves? Have you done your inspection reports? There's so many factors that go into all of that that people aren't aware of. So again, even if it's not hitting your radar every day, it's an issue out there. And as an LO who should be occupying your days filling it with nothing but mortgage related activities, go and talk to realtors, go to talk to your, the owners, the boards, that wherever you can get this however you can get this information out there. It's really important because it is an ongoing issue. And the idea, I've never even heard of wind insurance. I didn't know that was a thing. I mean, I've heard of, so I mean, so
It's a
just,
We don't
requirement.
get wind in California. It's not.
just
It's
when,
against the
yes,
law
we
here.
do every
Well,
once in a
you'd
while.
be surprised. You'd be
Yeah.
surprised that it is an issue right now for Hawaii. Fannie Mae put it on November of last year. So it's affecting a lot of these loans.
Wow.
And as far as when we were talking about different associations and stuff, I have a lot of Arizona and California associations that went into receivership in the last 30 and 60 days. So that is affecting closing. And a lot of it had to do with
What
insurance and
happens when your
reserves.
HOA goes bankrupt?
They didn't go bankrupt.
Okay. The receivership.
What they go into receivership because they couldn't get insurance. The ones in California tried for some of them almost 9 months to get insurance, and they could not get insurance on the project to the level they needed. And so now they went into receivership.
Wow. Okay.
Right.
We've
Hey,
been talking about,
define receivership for me, because I'm sure if I don't understand this, the difference between receivership.
Okay, what receivership is when the board, okay, say you have a condo association and they can't get insurance or they don't have the reserves met. They have certain requirements with the state to have X amount of dollars in reserves, to manage it, to have insurance. They get a time period, and I don't know what the time period is in California. It might be 6 months, it might be 12, because I've had Arizona, Nevada, and California all receivership ones this last 60 days. And what it all came down to was when they got insurance last year or in the last 6 months, they weren't able to, one, either get enough coverage, or two, it depleted their reserves so much that they fell into not meeting the reserve requirement of their condo. So the smart thing would have been to do a special assessment or raise the dues or whatever. A lot of them kept waiting to see, well, all it takes is a borrower notifying the state, they're put on notice, they have to fix the situation. They don't fix it, the state steps in and takes over the association.
so it's the state who steps in. That's it. Okay. That is interesting. And just out of
I've
curiosity,
never heard this. This is a new one for me.
what are these places for? Like, is this the lower end, the middle tier condos, or higher end, or all of them?
Okay, like the one in Arizona, the one in Arizona that I just closed the loan, those were selling for $750.
Wow.
The one in San Diego, they're selling, I think the studio or one bedroom selling for 1.2 all the way to 2.5 million. So is that,
Wow.
I don't really fault the associations. I mean, a lot of them said they were working on solutions,
Right.
just not fast enough. The state has their defined timeline, you
Right.
know, and you have to do it according to the state's defined
No,
timeline.
I know someone
In
who
the
was-
Arizona case, I found out.
I was gonna say, I know somebody who was on a homeowner association in the North Bay, and their insurance coverage went from $30,000 a year to $1 million a year in premium.
Correct.
You know, and so how do you, as an association, manage that? That's a phenomenal number difference. Like, they don't have the reserves, they don't have anything to, the special assessment. Now there were like 200 or 300 units in the building, so $1 million isn't as crazy, but still, that was a large amount of money for them to do a special assessment on, just for 1 year's insurance.
So what happens if you're in the middle of a refinance or buying or selling when that happens? You
Yeah.
need to be aware of, as a loan agent, to then you got to contact the lender, say it's in receivership. Will my lender still allow me to do this project? Yes, we will. I'm not speaking for everybody, but you
Right.
need
You
to
guys
know that.
will.
The other thing that comes when they're in the yeah, we will. But what happens is you have to make sure there were no deferred maintenance projects going on. My Florida one that went into receivership had a huge deferred maintenance. The balconies are all yellow tagged right now from damage from some recent hurricane.
Yeah.
Oh, lovely.
Yeah. Wow. Okay. Well, that's a somber reminder of something, and we've covered this pretty extensively. We have a really good show. I think it was in April with condoreview.com that Maureen and her crew over there, they're doing an amazing job of helping us. There's a way for a realtor to go in there, click a button, and order a report for a very reasonable amount of money ahead of time. Like if they're listing a property, if you want to know the status of your property, this is the same company that does the full reviews for mortgage banks. So they are thorough, they know their stuff, they're amazing to work with. So I highly, highly recommend that you look at that and suggest it to your realtors. And again, if a realtor doesn't want to tell their seller they should spend $300 to get a report to see what the status of their HOA is, that's foolish. It's just foolish. I mean, I had a conversation the other day with a realtor, and they have a listing, they're proudly showing their photos. And I said, so what's going on with the HOA? They had no idea, literally no idea, hadn't even
Correct.
thought to ask. And I'm like, there's so much out there where there could be issues that were averted, or you could just like make things simpler. It is so simple to do that, and people don't want to do it. It's outside of what they know, it's outside of their comfort zone, et cetera, et cetera. So anyway, thank you for bringing that up, because it is an ongoing issue. And what have been concerned about is it was going to be the lower end condo associations that would be hit first. And what you're saying is it's all over the board.
All over the board,
So, whew, yeah.
No.
Well, and some of them, what happened in the Arizona case, because I'm getting contacted by a bunch of them that went into receivership. One of them went into receivership because in Arizona, a lot of homes are second homes to a net owner occupied because of address. They lost their coverage, their insurance coverage. When they went to get new insurance, their dynamic changed. So it went from being, I don't know, 35% non-owner occupied to 100% because people were not utilizing it the same way. So then they couldn't get coverage. They even said, we're waiting. It's in Tucson. They said, we're on a golf course. We've had some of these residents have owned for 25 years, but we fault them because they changed their addresses to other addresses in states or whatever. And that hurt them in getting insurance. And now they're screwed. They can't do anything about it. So when you get a purchase or you're working with an agent, make sure you look at the HOA questionnaire, ask the agent to get it filled out right away, even before you have a buyer. Also, on the HOA questionnaires, there's stuff that sometimes the appraiser's coming up with because the agent did not do that up front. Yep. So then it's coming up in the appraisal and they're like, oh, I didn't know the place is in receivership. I'm like, okay, well.
And you also have to have I think a conversation should be had with the buyers ahead of time saying, hey, I want to make sure you want to buy into this association. I mean, here's what's going on. They really need to have their eyes all the way open. And sometimes they do, which is great. That's fine. As long as they are going in, understanding what they're getting into, groovy. But if not, then everyone has a problem later when they feel that they were somehow deceived or everything wasn't disclosed the way it should have been, et cetera. So make sure that, all those conversations are being had. And I have been telling people this for most of my career. Read the last 12 months meetings of the board.
Or go to board meetings.
I mean, you've got to read the minutes.
Yeah.
Outline what is happening. What are they talking about? What's going on? What are they expecting? Or if they have not had a conversation about, maybe having the report done on deferred maintenance, that is a tip off, because they should have, right? So that is, boy, I didn't even expect to go in that direction. I just want to say, so you mentioned that non-QM is not subprime and that you have really good credit scores typically, and they're really high. Like, I forget what the last number I saw, the average credit score on a non-QM loan was like, I want to
766, I think is.
I think you're, yes, I was going to say 747, but it's somewhere in that mid 700 range. That is, I mean, they're really solid credit-worthy borrowers. With that being said, I just want to take a moment and talk about July mortgage performance. The mortgage delinquencies, they got better from June. June, they weren't great, but they're still not, they're still, people are starting to have issues with paying their mortgage. So make sure, first of all, that you're watching statistics and charts, et cetera, because they make things, they'll say, oh, well, the starts are up 32%. Okay, well, that may be true, but from what? So in this case, so it looks like, okay, we've had this huge increase in delinquencies, which they have ticked up a little bit, but they're still at historic lows. Okay, so but my point here is people are starting to have issues, just like they're having trouble paying their credit cards and their car loans and their buy now, pay laters. It was inevitable that it would start to trickle into mortgages. So make sure you're staying in touch with your clients, letting them know that they want to have these conversations before they're delinquent, not after, or before their credit score gets below 700, not after, and see if there's something you can do to consolidate their debt or mitigate their payments that they're making, et cetera, et cetera. Tricia?
But I think that June number is part of the divorce season. So many people do not get divorced until school is out. So what happens is May, everybody is like, hey, I'm going to be leaving my wife. I have my honey on the side and I got to get them set up. So they start their divorce season behavior.
I have never heard
it. This is a new one to me too.
Okay, so the Black Knight and Ice attributed the June numbers to the fact that the last day of the month fell on a Sunday. And so the delinquencies then roll over and make it look like things were paid more than 30 days late when in fact they weren't. So, well, okay, you can shake your head, but again, this is something that happens data wise every time that the last day of the month is a Sunday, then it looks like the next month, it looks like that month's delinquencies are up. And then the next month usually neutralizes. But I'm very much interested in this divorce theory you have, because it's a Tricia Dave special for sure. So please expound.
Well, because families separate after the school year. Okay, so what happens is the reason we haven't seen this effect the last 2 or 3 years is everybody could sell their house for more instantly. So if you said, hey, wife, I'm leaving you, you tell her in May, in June, I'm not making the payments and you're on your own till we get to court. That delinquency did show because they knew they were going to be selling the house. Okay, everybody could sell the house, they split the money and be on their way. Nowadays, people are not as comfortable where the house is selling in hours, days, or minutes. We're looking at normal market times. We're looking at 61 days, 62 days. So do we see 30-day delinquents a lot of times now on mortgages? Yes, we do at the close because people aren't making it. So there's different times of year where people leave their spouse. People will leave their spouse. You had the nice little Valentine's Day. Things weren't not the way you thought it was going to be. This is the year I'm going to leave my wife, but I don't want to affect the kids that much. So I'm going to wait till the school year's over. So people wait till the school year's over. Also, someone said they filed for divorce in November, December, and January, another divorce season. Maybe that holiday you found out your husband bought a nice Christmas present for his little honey and you saw the charge bill, then you're filing for divorce. Those are the January effect. Maybe you don't want to have another Christmas you had with the last 20 some years with person. That's the other reason you're filing for divorce. There is a component to that. And I know I'm not trying to, we live in a culture that the divorce rate, what is 45, 50%? We need to understand that it takes two incomes to buy a house. It takes two incomes to maintain a house. A lot of times when people are having they're leaving a relationship, some people leave a relationship moving on to the next one. So they got to pay for that honey. They can't pay for the other honey too. They got to divorce them. So they got to stop paying the bills. There is that effect. And as far as, they were saying people's delinquencies because interest rates rose and the amount of inflation and stuff like that, that is a key factor too. But when you have economic and financial stress, that contributes to divorce.
Yeah, it does.
So again, it does. And so what I'm saying to you is, I do think we're going to see an uptick in divorce this year. We're going to see an uptick in the people that, my kids will now be going back to school in the fall at a new address because they separated over the summer, or they separate in December. So January changes the situation. It's not that unusual. And as far as qualifying for a mortgage, that it does affect people. So make sure if your spouse you're getting divorced and you are not making the payments, then you reach out to the lender, say you have the property for sale, and see what you can do so you don't report a late.
Okay, so Dirk is on fire over here. He said, my ex-wife left in November. Does that make me an outlier? The answer is yes, Dirk. You are an outlier. You've always been an outlier. This is just one more piece of evidence that you are an outlier. He also said it was an early Christmas present. And he said, someone stole my credit cards. I didn't report them stolen because they spent less than my ex-wife. I'm like, God. All right. He's gotten his moment. Jeez Louise.
It was her new boyfriend.
What?
It was her new boyfriend.
Okay, so let's move this along, shall we? So the NAR settlement went into effect August 17th. So as with Y2K and, the world was going to come to an end at that point, there were a lot of forecasts of there being huge disruption in real estate on August 17th. So far, we're not seeing much of it, or I've not really seen any. I'm not seeing any. I just want to take a moment before we start this conversation to say that I have heard from multiple compliance people and attorneys, LOs. I am seeing suggestions that we get involved and solve the realtors' problems. And the legal advice is to stay out. Do not do it. So Tricia, let's start with, have you seen anything different since the settlement on August 17th?
No, and that's actually what Audrey and I were talking about. I checked our pipeline, and when I looked through our company pipeline on purchases, all of them still had the seller still paying a commission. That being said, I don't like to admit this, but I'm from Indiana. And so a friend of mine who lives in Indiana, they wrote an article for the Post-Tribune there about how it's not impacting Indiana. And since when you're from Indiana and they know all your business and I know all their business, I decided to get a little bit more into this article. That being said, I found out that they are, when they're taking listings, they're making sure that they put in there that you can ask for the seller to pay commissions. So the article was kind of enlightening to me. So I reached out to brokers in Illinois, Florida, Tennessee, and asked them, what are you seeing? And they said, business as usual, we're still getting commissions. So it has not had the effect, but I have had agents say that they have been asked by the listing or the buyer's agent, can you write in the pre-qual letter that my commissions to be paid by seller? You, as a lender, I would never say that. And as a loan officer, you cannot say that legally that the seller needs to pay the commission. So you can say, I mean, I have them sometimes where the person was pre-qualified with the seller paying 3% closing costs. You can still write that, but you cannot write anything when it has to do with the real estate commissions. Even if it's your best agent asking you, you cannot do it. And no lender is going to require you to do it.
Right. Yeah. Be careful, guys, because again, I'm hearing all sorts of things, and I'm sure you are too, where, oh, the LO is supposed to act as the buyer's agent. The LO is supposed to do this. The LO is supposed to do that. And stay in our lane. I have a friend who's told me to stop saying that. I told him I'm not going to. We just need to like we need to
Well,
be
speaking,
really
speaking
good
of
at
staying in your lane, so
what?
this is actually an opportunity for LOs because there's still a lot of questions about this. And there's real estate conferences coming up through who is it? WRE News is doing them, and association with the National Association of Realtors down. Well, first one's down in Florida, on Miami on the 20th of September. So it'd be a good opportunity for lenders to invite their realtors, say, hey, let's go. And if they do it through us, we can get them a discount. The $350, they can knock $200 off that. All they have to do is put MP411 in the registration. So if you go to wrenews.com and go to conferences and then register for classes, three of these are coming up. The three big states, Florida is the first one in September, then Anaheim in October, and then Dallas and also in October.
Just to be clear, Anaheim and Dallas are not states; those are cities in states.
I know, but
in big
people
states.
know
And with that
Anaheim,
being said,
California, Dallas, Texas, Miami, Florida.
but I think the point is good where we need to get
That
out there
being
with
said, if you can't make one of those three
Uh-huh.
what?
We lost you. That
No,
being said,
if you can't make one of those three conference can you hear me now?
yeah, we can. You're a little bit of delay, but we
Okay.
can hear you.
That being said, you should attend many because of the changes going on in the market right now. You should attend any and all things that are local to you. I know we got in the habit of not attending things and stuff. And what Audrey leaves out when she said I didn't leave my house for a few years, I really was bogged down and it was hard. And prior to that, I used to travel like 300 days a year. So I needed to rest up. And so the bottom
Listen, I
line
didn't
is,
want to go into your
if
whole
you
history, but you know,
we have right now a very
go.
Yep, you froze again. We have a very what?
okay. Yeah, sorry about that. So the other thing is,
I don't know. We keep losing you.
can you hear me?
We can, but you keep cutting out.
I don't know why. I don't know why.
That's
But
weird.
go to even your local real estate meeting, go to mortgage meetings, go to whatever right now, because you want to hear what dialogue's going on before those contracts are written. So you as a loan officer have your input to what you're willing to do and that you can navigate through this.
So what I'd be concerned about in some of those contexts, and that's why it's important to tune into something like this, where we are actually telling you what the real deal is, and then go look.
Now we've lost Audrey. What's happening? Am I the only one here, or have I dropped off? You're there, right, Tricia?
No, can you hear me?
Yeah, I can hear you.
Yeah, I'm here.
Yeah, we just lost Audrey though. I don't know where she disappeared to. I think there's some secret organization out there that does not want the world to know what we're saying. Oh,
Okay, the other thing is, for example, this week, can you hear me?
I can hear you.
Okay, the other thing, this weekend, I attended the Memphis swap meet with the broker loan, and they were the swap meet to go get ITIN loans. And interestingly enough, the broker, I was on the phone for 2.5 hours. He walked through the Memphis swap meet. He ended up with 9 ITIN loans. And this morning he ran the credit reports. We have 9 loans over 700. But
really?
Like he was saying, he goes, a lot of people had questions that were real estate questions with him.
Yes.
And
no, that's good.
So the questions we were getting back to what, we were getting real estate questions though, more so than loan questions. And you just be careful as a loan officer. We don't want to answer questions that are not in our product realm, or we don't want to give advice that we really are not part of. So if they're being told one thing by a realtor, what I would tell them is then consult another agent, or here's one of my real estate partners that I trust, and give
Brokers.
them to one of those realtors. It's very important though to get out in the community. So we were at the swap meet. He's walking around for 2.5 hours trying to get ITIN loans, had me on the phone while he's walking around. We were having a good time with it, and it was surprising to me how many people wanted to talk to him without the realtor present. They said that they were out shopping for a house and they went with the loan agent that was with their lender, but they'd like to talk to someone else. I mean, I wasn't flying out to Memphis this weekend, so it was very interesting to experience it, via Skype, via FaceTime or whatever. I had a great time. I felt like I was back in Indiana again.
Welcome back, Audrey.
I know. Good Lord. Gotta love Wi-Fi. Anyway, just to wrap it up in a nice little bow, make sure that you are not giving legal advice or regulatory advice. You can tell someone you think something, they better go check it out with a broker, with the Department of Real Estate, with they're presumably with a trade association, but there's so much crap. And again, just a reminder that NAR settlement is not finalized. It's not. So
Nope.
it's still a moving target, and we'll see what ends up happening. Okay, so just to recap, so far we're not seeing a whole lot of effect in the market, and depending on where you are in the country, I can assure you that I have not heard anyone say in California that they're going to just keep, putting it out there, that the seller on MLS, that the seller will pay the commissions. And also we're calling them some concessions now, I think. And anyway, so it's, we got a ways to go on this, but everyone will adjust. It's going to be fine eventually. And just people need to get out there and look for a place. So one of the things that is interesting right now is you talk to people and they're still waiting, right? Oh, rates are coming down. Oh, I might get $25,000 towards buying a house. And meanwhile, appreciation levels just keep going up. So
Yep.
you're not really, you're not achieving.
I want to interrupt you there. How much do you think home prices will rise if everyone has $25,000 towards their down payment? It's going to be more than $25,000.
Exactly. But again, people are not
We
buying
did this
houses
once
because they
before.
need $25,000. I mean, in my opinion, no offense, but that would not be where I would put my money, is into a program like that.
Right.
So it again.
But if you remember,
And now
do you remember when the Obama administration did this? And
yes.
then yes, and I'll be honest with you, so what it did was you had homes that were substandard that instantly went up $25,000. Or whatever I don't remember what the incentive was. I think it was 20 back then or 10. I don't remember.
Something like that.
They got a $10,000 tax credit.
And it moved everything ahead. All the transactions moved ahead in the year. So like everybody suddenly raced in to get that money. And they ended up paying more money than the $20,000, whatever the amount was.
Correct.
Above. And then once the money was gone, home prices dropped well more than $20,000. And like the market just stopped. And so anybody who had bought in at that time, they lost their money. It was quite interesting to watch. It was like one of the dumbest moves I've seen on a government program way back in the day. And I think
Correct.
Yeah.
The other thing, when Audrey called me to do this Friday, one of the things we discussed, and she had forgot about doing it. Most people know, or I thought they did, you can reach out to the lenders you do business with and get white label marketing material. Yeah. And I strongly encourage that. The reason is if you're developing your own marketing material, you might be non-compliant.
Yes.
And the nice thing about working with a lender, you're making sure all the legal jargon, all the stuff about programs and what you can and cannot say is being addressed. And so when I say partner with a lender or have a good relationship, it is very important to do that and use their white label marketing material, because it makes a huge relief to you in the community that you are doing things legitimately right and with little effort. I mean,
right.
Most lenders have the white label marketing, and in the social media era right now, you can really make a lot of money with spending very little.
So Tricia, let me ask you a question about that because we had an interesting conversation with the DRE commissioner a couple of weeks ago, and they, God bless them, California's Department of Real Estate offers that for for $1,000, for $100 they'll review your marketing materials, which is great. But you know, how much of it, like, is it per piece? Is it per, they'll look at a website, they'll look, but if you're cranking out a bunch of things, how do you guys do it when, you've got all these different states, and you have state regulations, federal regulations? I mean, are you guys pretty on top of all that? Sounds like yes, no.
Yes, we do. So that's what I'm saying. For a flyer, that's why people, when someone says, hey, I need a flyer, could you guys do it? It takes us 5 to 7 days. My marketing material, our marketing department, one, has to come up with the flyer. Two, they have to vet it through legal local channels to make sure. Like, I can't advertise an interest only loan in Dallas, Texas, because they do not allow interest only.
Like
My
Dallas,
site
Texas,
do it.
not
So
Texas, but Dallas specifically, like the city has its own regulation. Is that it? Huh.
correct. Dallas County does not allow interest only, and so you have to make sure that you're adhering to those compliance issues when you're doing this.
Yeah, exactly. So again, to anyone who doesn't know what white label means, it's when they have their marketing materials and then you can put your name on top of it, and you guys will do it for them. That is invaluable. So just to be clear, you'll do a flyer. You said social media. What do you do for social media?
Hey, much to Audrey's dismay, I had my guy go to the Memphis swap meet in I do ITIN loans. And that was on the front of his shirt, and on the back was the name of his company and phone number.
Wow. Wow.
Mavis made the shirt.
Well, she threatened to do this with me. I told her.
Okay, so he got to this. So he literally spent $7 per. Yes, Mavis did. So he sent her a shirt and she embroidered it or whatever she does to it. Went to the swap meet. It was an antique mart swap meet. He spent $2 to park and I think $5 to get in. And he had me on FaceTime. We were meeting with different people. And he went up to them and he said, people said they knew what an ITIN loan was. That was hilarious that he had people coming up to him. Oh, you do ITIN loans? And he goes, yeah. And he goes, I had him wear Big Bird yellow too. So I called it Golden Boy, like from Seinfeld. So he wore Golden Boy to the swap meet. And I said, because football's going on right now, people are paying attention to logos and emblems and everything on a shirt. So we do ITIN loans. He got approached by so many times, and he had me on FaceTime the whole time we're walking through. People were like asking him questions. Do they need a credit score? Do they need a job? I know somebody, my friend or whatever. It was really fun. And I have no idea that I became a human billboard.
So what do they need for an I-10 loan? They need a credit score? No credit score? Yes, no?
They not necessarily, but they do need a credit score. On an ITIN loan, you can go to 85%. And a lot of times we as a go over and above because we'll allow the pay stubs and the W-2s to be under a social. We go off the ITIN number on the tax return. The ITIN product is really an underserved product. That market is not touched. Surprisingly enough, he got a lot of truck drivers that came up to him. You also remember a lot of your ITIN investors, they have been stuck in the hard money market. So they're at 15%. You're going to refinance them into an ITIN DSCR, which is an ITIN DS 80% all day long. I mean, my guy was like super thrilled. We went and had a beer via Skype afterwards to celebrate. And then when he got the credit score stuff run this morning, he was ecstatic. I mean, it really was a good thing. So Audrey, Mavis is ready to make you that shirt and we'll get you over to.
I told her I don't wear t-shirts.
Kevin would wear one.
We'll see what we can do on that. I want to spend the last few minutes talking about ideas for getting business, because again, I know there are a lot of LOs out there who have been sitting around waiting for the rates to come down, which I have continually said, stop doing that because there's so many different loans, there's so many different things. And now we're at 85, is it 85% of the market right now is people doing refis, which is crazy. But again, it's so critically important that we don't lose sight of the fact that we have to stay focused on purchases. That is the lifeblood of our business. Okay, I'm sorry. Refis are 47% of all transactions.
Wow.
47, but that's half.
Yeah.
I mean, that's a lot. And so it's great that we have that business, but people tend to get derailed and sidetracked from staying focused on the thing that persists no matter what the rates are typically, and which is purchases. So going into the last quarter of 2024, what would you say is the hottest thing out there? What should people really be looking at doing? What are you doing most in the loan non-QM segment of things?
I am still a purchase person. So my pipeline, I ended the month still at 85% of my pipeline is purchase.
Oh.
So,
Rest my
but
those
that
purchases, where do
being
they break
said,
down?
I've told my guys for every state-wise,
Just what's the breakdown on?
I still have a lot in California.
No, I meant like, is it DSCR, ITIN? Is it?
Kevin, you're cutting out.
Ooh.
Okay, I don't know the exact numbers. I would probably say 30% of mine is ITIN or foreign national. And the reason I say foreign national, my foreign national programs, they don't require a credit score or US income or credit. So they literally, you have Florida, which is a huge foreign national market, Arizona, Nevada, California, Hawaii, all tremendous foreign national markets. The ITIN, the reason the ITIN has always been consistent, and I try to keep about 30% of my pipeline, ITIN is typically not rate sensitive, they're solution sensitive. So if you can do ITIN loans, you'll get another ITIN loan. The other thing is if you do, like I'm getting a lot of condos and I know why I'm getting condos. Like I told you, Kevin, I think that what happens is I'm closing one in a project and then every time one comes through, we're getting the next one. Right. So that's kind of building in that. The other thing is self-employed P&L only loans are real popular right now, or self-employed where they've only been self-employed for 12 months, or they went from being W-2 to 1099 in the same field. A lot of that. Explain
a self-employed P&L loan. What are the requirements?
A self-employed, it's a 12-month P&L unaudited, so you don't have to have supporting documentation, so you don't need a bank statement or anything to support that income. It's literally a 12-month P&L prepared by an EA or a CPA attesting to, I prepared this for this borrower and their business. So you're not, and then we go off the net income.
Not just making up something then.
Yeah, you're not just like doing shots and coming up with whatever the numbers are going to be on it with your borrower. This is somebody, a tax preparer, doing it.
Correct. But most of the CPAs that I've seen, they want the borrower to furnish the numbers for them.
Okay.
So the borrower does need to finish the numbers, and you as a loan agent need to review that with the borrower before they send it to the CPA, because we're going off of the net income. So we need to have enough net income to pay for the loan and to be less than 50%. So if your borrower says, well, I'm sending it over for their loss, if it's a loss, we're not doing it.
Got it. Yes. Well, okay. So we often hear about situations where someone got the conditions from the borrower, didn't bother to look at them, send them in, and it blows up the whole freaking deal. So yeah, that is a cautionary tale for sure. And by the way, we have a comment in the chat from someone who said, did you see the interview where the candidate said that it was going to be a $25,000 tax credit? And the article that I was looking at did not say that. It just said provide $25,000 in down payment assistance. And so again, I don't think we have a whole lot of information on that.
And it's still just a bill. It's not passed.
It's
only in California.
I don't even know if it's a bill yet, to be honest. And actually, there's a bill in California that I'm hearing a lot about where they passed it in the legislature and they're waiting for the signature by the governor. We don't know if it will happen or not. That would give undocumented interest immigrants down payment assistance and access to it'll make it easier for them to buy houses. So a lot of controversy around that, which we're not going to get into here at all. But with that being said, thank you, Tricia, for being here this week. Thank you to everyone for showing up the day after a 3-day weekend. It's always a little hairy to do that. And we will look forward to seeing what happens this week with the jobs reports, etc. Tricia, is there anything else you wanted to say before we call it?
I do. I have one little thing.
Nope. Thank you very much for having me.
For the new education company we're working with, it's not Mortgage Educators and Compliance from David Luna's old days, since he's now retired. It is Mortgage Education Institute. If you just type Mortgage Education Institute, you will get Mortgage Educators website. You have to go down a little bit further to find MEI's website, and it's a black and red logo, so you can know it by there.
Just email me if you need more information on that, guys.
Okay.
All right.
Yep.
Have a wonderful week. Go get some.
Get Trish, get better.
Thank you, Tricia.
Bye-bye. Bye-bye. Talk to you. Bye-bye.